Hello and welcome. You're watching Business Today TV. I'm Sakshi Batra. This is the earnings special edition, and we are going to be focusing on the earnings of HCL Tech in line with the expectations on the street as far as the revenues are concerned, but slightly weaker on the back of margins as well as guidance. Mr. Prateek Aggarwal, now the Chief Financial Officer of HCL Tech, is joining in to give us some more insights into the Q4 earnings as well as an outlook going forward. Warm welcome to you, sir, to Business Today TV. Always a pleasure to host you with us. Do tell us, sir, first of all, as far as Q4 earnings go, how did you on your own assess it? Was it in line with your own expectations, slightly on the lower side? What went right, what went wrong, sir?
Thank you. Good morning, and thank you for having me. I think we are very pleased with the results. For the second consecutive year running, we are happy to be the leaders of the Tier 1 IT services pack in terms of growth. You and viewers might remember that FY23, our services business grew at 15.7%, which was then the highest compared to everybody else in our typical peer group. And this year as well, our services has grown at 5.4%. Our total company revenue has grown by 5.0% in constant currency, and in rupee terms, it's 8.3%. So we are very happy to be leading the pack, and hopefully we can continue that in the next year as well. So that's on the top line side. As far as margins are concerned, we have continued to be in the 18 to 19 band for the last 2 years, 18.2% actually exactly the same in the last these 2 years. So that is stable margins, and we continue to maintain that guidance for the next year as well. Very importantly, there are other metrics of profitability which we also focus on, and we are probably one of the only companies who's actually publishing a return on invested capital ROIC page in our investor release every quarter for the last 2-3 years now. And that is a metric which is very important because it focuses not only the EBIT but also the tax aspect. And then the second thing it also focuses on is capital efficiency of our business. And there, if you see, we have improved the ROIC of the company by a solid of the company by 3.4%. So we are now at 33.8% on a 12-month basis. So we have just in 1 year, we have increased by 3.4%. And if you look at it from a services business perspective, it is now at 41.6%, which is an increase of 4.3 percentage points. So those are very healthy ROIC numbers in absolute and certainly in terms of growth. And even our software business ROIC has grown.
So, CVK also expressed some caution as far as a potential hit to the company's earnings side, and the company switched to a global delivery model going forward from here in the next quarter. Could you tell us a little bit more as to how much would that impact be? Where exactly would the impact be felt? And would it be only 1 quarter off, or will it be also extending to Q2 and Q3?
No, so it's a 1 quarter thing. We have explained that. We gave out the number in the analyst call yesterday, last night, which is expected. The June quarter is expected to be a -2% on a sequential basis. So that is been given out. Excuse me. So the global delivery model mentioned was basically the offshoring of one of the large deals that started execution in the month of March last year. So that is now completed 12-13 months, and it is now time to offshore that a lot of that work. And that is the revenue goes as per the offshoring parameters, right? So that is one large impact. And even generally, April month tends to be that month of usual annual productivity pass back. in a number of our earlier contracts as well. And therefore, it has been a seasonally weak quarter for us. Even last year was 1.3% lower.
Hmm.
So that's the reason we've called it out. One, because we don't want people to be surprised
Yeah.
next quarter when we come and publish the numbers. So better to inform everybody upfront. And second, also it helps to explain why the guidance that we have given. I know
Yeah.
people are expecting a little bit higher, but
Yes.
the guidance we have given is predicated on this, and also our assumption that this year may pan out to be, similar to last year. And that is what we have penciled in. If it turns out to be better, we'll all be happier.
Right. So since you are saying that if it turns out to be better, you'll be happier after Q1, and as and when the demand scenario improves for the industry, would you still be hopeful that at least you can look at a revised guidance, maybe the lower band a little higher as well, from 3 to 5% to maybe a 3.5% to 5.5%? Is that something that you may probably look at?
If the environment improves, certainly, why not? I mean, just to complete the story, since you asked that question,
Mm,
I think the point is, after that -2% in the first quarter,
mm,
the guidance range of 3.5% means a CQGR, cumulative quarterly growth rate, from Q1 to Q4 of 1 to 2.5%. So that, I think, is a reasonably good CQGR. 1% we should be able to hit for sure, even in this environment. That is what we have done in the past year as well, or better than that. And if the thing, I mean, we would certainly want to hit the 2.5% even in this environment. But there is a lot of work to be done during the year. We are just starting out the year, and this is our
mm.
best estimate at this time.
Okay, and what levers, sir, will you have to improve the margins and that band of 18 to 19%? Or are you looking at any tailwinds emerging in the second half?
I think the margin levers are basically those same 4, 5 levers that we typically rely on. Number one is utilization, because that is the biggest lever that we have. We continue to hire a number of freshers even in this little bit of a low growth environment, and we are going to continue that even in the next year. So last year we hired about 12,000 freshers. Next year we are penciling about 10,000, and if the thing gets better, maybe more. So we continue to work on the pyramid and maintaining our cost base effectively. And then, of course, offshoring itself tends to be a good lever. It helps our percentage margins. And automation and all kinds of new technology implementation continues to be a good factor. Attrition continues to be very low, so that should help
Yeah.
as well. And then, of course, we always try to improve the realization of the revenue per FTE, revenue per employee, that we continue to work on and see how best we can continue to improve.
Hmm.
But apart from the ROIC, which I already mentioned, and the EBIT that we are talking about, I think again, free cash flow is an incredibly important metric to track. In fact, probably the most important metric. Of course, revenue growth, EBIT, all of those are infinitely important. But at the end, all of that has to result in free cash flow. And that
Yes.
is where we have seen the best success, actually. 28% growth on a year-on-year basis,
Hmm.
reducing our DSO by 5 days on a year-on-year basis, from 88 days to 83 days, which is including the unbilled revenue as well. And ratio of 136% of the net income. These are outstanding numbers by any yardstick, I would say.
So, since you did talk about on the April wage hike factor for this season will play out as well, what are your thoughts and as to how much can we expect as far as variable pay is also concerned? Your peers are also talking about a strong stance to usher people back to office all days if they need full variable pay. What is your own thought process here, sir?
Right. So a number of questions there. I hope I remember all of them. Uh, so first of all, Sakshi, I think we have a slightly later wage cycle, increment cycle. Typically, we actually do it across 3 quarters in the normal cycle. Last year, of course, it got deferred a little bit.
Yeah.
Uh, in the first tranche, we cover close to 90% of the people, which is the bulk of the pyramid. And that is typically the normal time frame is July. Uh, the second, this thing then for the middle management comes in basically in 1st October. And then the third for the senior most management comes in the January quarter. So typically that is the cycle we follow. Uh, Given the environment that we have penciled, we'll have to see how we do it. A little bit will depend on what is other peers on the in the industry who sort of take those decisions a little earlier. So we will wait and watch to see what happens. So that was uh, probably just one of your questions, right? So
Yes, sir.
your other question was
Uh,
return to office, right? So that
yes, sir.
that is something which we definitely want our people to come back. And over the last several quarters, maybe 3 or 4 quarters back, we started with the senior and middle management saying that you have to come back to office at least 3 times a week. And then we expanded that to pretty much everybody, saying that 3 times a week is essential because it is important. We are a services industry. We need to have people working together with each other instead of everybody at their home. And there are cultural aspects, there are quality aspects, there are confidentiality aspects, security aspects. So for all those reasons, it is important for them to come back. However, we have not done, as you mentioned in your question, taken any punitive kind of steps to force that. We have tried to do it more uh, by positive sort of way of getting them back to work is how I would put it.
So, last two questions. One on Gen AI, sir. We've been always asking you this. You also mentioned that there is increasing traction in the Gen AI deals. Is it becoming sizable enough that you could start quantifying it for us as well? Meaningful contribution to the top line?
Uh, Not really, not yet. We certainly, everybody is extremely excited about Gen AI and overall AI as well. And you may have picked up that we have launched our AI Force as a sort of branded offering, and that is being very well appreciated by customers. In fact, very large customers have, including Microsoft for that matter, actually. So they have appreciated what we are doing there. They find it to be quite unique, actually. So we are continuing to take those offerings and we continue to work on a lot of proof of concepts, pilot projects, and some of them in the last quarter have started resulting into bigger, projects as well. However, it is still a number which is not a meaningful contribution to the totality. But hopefully, it will keep on improving by leaps and bounds every quarter. There is also the aspect of the surround kind of revenue in terms of either regulatory and compliance, or it could be cyber security. Data obviously is very important, and the consulting part, which is all this is all going behind. So
Right. So you did mention two new $100 million clients this time around as well. How do you see the deal pipeline headed for FY25? And what is exactly working for you, which is not working for your larger peers? Because you've constantly reported positive outlook from even North America and as well as BFSI, where the industry is lagging. So what is really the stark? What is this, better that you're doing, which the industry is probably lacking?
Yeah, so that's a longer term issue and a longer term answer, right? So I think the way I would put it, Sakshi, is so first of all, we continue to have a very robust pipeline, and we continue to develop that to first wins and then to revenue very consistently. Last quarter, March quarter, also we won 2.3 billion of deal wins, and just to remind our viewers, the deal win TCV that we publish is only net new. There is no degree of renewal kind of a element in that. And the second thing is it is all firm orders, as we call it. The firm order could be in the shape of a statement of work or MSA, Master Services Agreement, or it could be just a purchase order. So we don't publish data which is kind of in the future based on some projections. And if we get just a rate card, which is like a menu card, right? When you
Yeah.
go to a restaurant. So until and unless the statement of work for the work to be done or a purchase order comes in, we don't publish that. As and when it does, then it forms the number. So I think we continue to focus on our strengths and develop newer strengths as well. And in the last 4 or 5 years, especially since you talked about financial services, over the last 5 years, we have added a number of new, very marquee clients to our roster. Very, very, large banks and financial institutions, insurance companies as well. And that business continues to grow even today. I mean, even in this environment, we continue to grow that. It's like small growth every quarter over the number of 5 years. And now some of those clients are actually $100 million plus. So that's where you started your question. So just connecting the dots back.
Well, all right. Thank you so much, sir, for speaking to us on business today and explaining to us what worked for you in this quarter and where do we see the company growing headed from here on as well. All the very best for the upcoming quarters, and we shall catch again very soon to understand more about the company and the industry going forward. Many thanks, sir.
Thank you very much.